All right, so this is an excerpt here from a presentation I gave recently. The slides here are really showing some of Keystone's great capital compounding recommendations over time. The point of this section was to show investors the powerful effect of adding just one or two truly great stocks can have on your portfolio. And I said it's a very simple but powerful concept, but not one you'll hear from most advisors. Essentially, investing your two or three truly great stocks in your lifetime can be game changing in your portfolio. But don't just take my word for it. In fact, the past year, Warren Buffett, perhaps the greatest investor of all time, stated that in his 58 years of Berkshire management, his satisfactory, and we all know they're well above satisfactory results, have been the product of about a dozen truly great decisions. That would be about one every 5 years. So let that sink in. What he is saying is that only 12 great investments or stocks in his almost 100 years on this earth made him one of the richest humans on the planet. It does not take many, and perhaps most importantly, they do not have to be complicated moonshot businesses that promise to change the world. Often they are most boring or mundane businesses you can imagine. One of Buffett's greatest wins came from Coca-Cola. They are a seller of soda pop. Others include Bank of America, a banking business, American Express, all businesses we can understand, all returning massive capital compounding returns, and are all a reminder of this, that boring businesses can produce astonishing returns with less risk. Now, I like to give real world examples from our research, and these are the types of boring businesses from our research that you can look at today. Four of Keystone's recommendations that have literally changed the fortunes of our clients' portfolios. I put these numbers up here because they kind of make us look smart. Quite frankly, the other three guys need it here, but me, not so much. So I do it for them. My real point is here to show that boring businesses can produce astonishing returns. What does Boyd do? They own automobile repair shops. They fix cars. Hammond Power makes electrical transformers. It's been in business for over 100 years. Expel, they sell automobile paint protection film. Water Furnace makes geothermal heating and cooling systems for homes. Not sexy, but look at those returns, and that's what you're looking for. Having heard this, I say a couple of questions should pop into your mind. How can I find the next Expel? And we get this question all the time. Boyd, Hammond Power, or Water Furnace, or what do these great businesses have in common? Now, as far as the profile of a stock you should be looking for, we have literally created 3-hour webinars on this topic. We don't have time to go into that today, but I want to keep it simple. You're looking for great cash flowing businesses with good management teams that trade at reasonable prices and have a long-term growth path ahead of them. Now, number two question should be, how do you construct a portfolio to capitalize on the great capital compounding stocks like these? Well, first, as we say, do not build it with the traditional big bank portfolio model, where your advisor complicates your portfolio with 5 to 25 plus ETFs, funds, or other investment vehicles, each of those owning 50 to 200 plus stocks, leading to a portfolio that holds 500 to 1,000 stocks, which is essentially owning the market. If you construct a portfolio in this manner, even if one of these great stocks makes it into your portfolio, it will be one of 500 or 1,000 plus individual stocks, which will not move the needle in terms of returns for your portfolio. What we advise to do is very simple. Build your own stock portfolio. Take control. If you want to beat the market, you cannot just be the market owning 5 to 25 plus ETFs or mutual funds. Now, what you can do is create your own simple equity portfolio. It's a strategy that we've coined focused diversification. What you're doing is building 15 to 25 stocks in a portfolio gradually over a period of 12 to 24 months. What this does is reduces risk or exposure to short-term market corrections, and it provides flexibility to add to new positions as new opportunities or new research becomes available. What is the process here? Well, if you're going to use our research service or you wanted to go it alone today, start the process. You can start with 3 to 5 initial positions or stocks to add to your portfolio. You can add 2 to 3 new stocks per quarter as new information or research is released. You can also layer into those positions. You don't have to buy a full position. Say you had $100,000. Let's just use round numbers, and we're going to buy 10 stocks. Take 100, divide it by 10. It's 10,000 in each. You might buy a half position, which would be 50% of that, or $5,000 to start, and add to that over time. So let's look in practice an example of what the structure of a portfolio built with a focused diversification strategy would look like. Here, we can see our 3 core areas of research. You're going to have 7 to 10 stocks deployed into these 3 core areas. The core areas: Canadian small cap, growth stocks, those lesser known companies, good profitable businesses, core Canadian dividend growth stocks, and core US growth stocks, 7 to 10 in each area. I put together a simple example also. It's an allocation example here. If we see, if you had a $500,000 portfolio, nice round number, 20 stocks in each with an equal weighting. What I mean by that is if you have $500,000 to deploy, divide that by 20 individual stocks, you're equally weighting them at 25,000 in each. Now, what my goal here is to show you is how impactful one great stock can become on a $500,000 portfolio. As you can see here, this is the $500,000 portfolio. 15 years ago, for example, Boyd was included on an equally weighted basis as one of our top recommendations at that time. Today, if you would have bought them with that $25,000 position as one of those 20 stocks, Boyd itself would be worth in the range of $3.3 million. Just one stock is worth nearly 7 times the entire original portfolio. Literally all other 19 stocks in that portfolio could have gone to zero, and this portfolio would still be in solid shape. Of course, we are not looking to have all 19 other stocks go to zero. We're looking for growth in those businesses as well. But it shows you the truly amazing power a great stock can have on your portfolio if combined with the right research with a portfolio built in this model. Now, if you had $1 million in that portfolio, it would be worth $6.6 million today, that one position in Boyd. And the returns are even better if we use Hammond Power in this example. That is now outperforming Boyd. So I think there, my point is made, and we can move on to comments from our other gentlemen on this podcast. They got nothing.
No, I got something because I need to make myself look smart. After you were sending shade our way. I had one conversation with...
That's all you remember from that entire presentation is that little bit of shade, right?
So I had one conversation with a lady at the booth, and, I said kind of what you were saying, where, we're looking for, like our value proposition is we're going through every single stock in Canada. We're going through thousands in the US to find, the Boyd or the Hammond. And I said that to her where, all of the other stocks in your portfolio could literally go to zero, like you said there, Ryan, the 19 could go to zero. And she gave me a crazy look like, what do you mean? And, we're using that as an example. Again, like Ryan said, it's an extreme example. Again, the businesses that we're looking at and recommending, they're cash flow producing. They're not cash burning, good balance sheets. These companies, aren't going to go to zero. I have been with Keystone for, 5 years now, and I have not seen any of our stocks go to zero, so just making sure that is clear for people who heard that.
Yeah. And like we said, those 20 stocks, the other 19, not all of them are going to be successful. And even if you've done all the research in the world, if we've done all the research in the world, you're going to have some losers in that area. But if you have, a few great stocks in there, it allows you to make mistakes. But you also can get good gains in that other part of your portfolio. And then you can really achieve the wealth that a lot of people are really looking for. If you just want to mirror the market, there's better ways to do it than most people are doing it out there too. Just buying simple, low cost, 3 ETFs to cover, one to cover Canadian, one US, and one international. Many people are being charged like a 2% administration fee to do that. You don't need to do that. You don't need our services or help to do that. People come to us because they're looking to beat the market and they're dissatisfied with their returns in their general big bank type design portfolio. And that we're trying to have them have a fighting chance to structure their portfolio properly to be able to take advantage of good gains in companies and not just be the market. That's why again, we're not buying 2 or 3 stocks. We're not buying hundreds of stocks. it's a sweet spot in 15 to 25, depending on the size of your portfolio.
Yeah, one thing that I'd also like to add, just that Aaron made in his speech at the World Outlook, which I think is like an important, and it was really good, where he was complimenting Ryan and saying that Ryan's small cap discovery research has been very top tier. Not only because he's found the Hammonds or the Boyds or whatever. There's many other names that like International Road Dynamics, H2O Innovation, which just recently got taken out.
Photon Control.
Photon Control. Again, like these are, thank you, Ryan.
It's okay.
Like these are companies that, 200, 300, 400% returns as well. So again, obviously we're looking for those, 1,000% returns on stocks, but, again, we're finding other businesses that are obviously, having value over the long term.
Well,
and the thousands of print aren't the most
but I don't
realistic.
appreciate being reminded that I actually complimented Ryan.
That's true.
Yeah. I don't blame you.
Moving on from that.
I'll just say people ask a lot about how we can find the next Boyd or the next XPEL or the next Hammond. And you don't necessarily know when you're recommending a company where it's going to end up. But the point is, you're basing it on the model. So the model of all these companies is the same, and that's that they're profitable businesses that are growing and that have some type of a growth strategy or are serving a market where that growth should be sustainable over time. So then that compounds. In the case of Boyd and Hammond and XPEL, when they were originally recommended, they were largely unknown and underfollowed, right? So that's another thing. So finding a great business, the great product in a strong market that is being ignored. And that doesn't happen every time. That doesn't happen every recommendation. But in order to find the next Hammond, you stick with that model, really. And as long as you stick with that model, even though a Hammond doesn't come, every month or even every year, you eventually get exposed to the Hammonds.
Yeah, and you have the potential if you structure your portfolio that way. That's
the ones that don't become Hammonds, more often than not, still go on to perform very well.